Welcome back, you legends. I'm Dr. Cal, and let's get right into this video. I have a lot of exciting stuff in this video. I will try my best to get through all of these as quickly as possible, so make sure to watch from the beginning to the end. If you want to go through the video much faster, please go into your video settings, click on playback speed, set it to 1.25, and you'll get the same content but at a much faster rate. Please do not skip any part. I have a lot of critical information in this video that suggests the market has probably topped. So let's get right into it. The S&P 500 today closed down 0.42%, the Nasdaq 1.2% down in the red, the Dow 0.18%. Taking a look at the stock market map, we can clearly see this massive glowing pocket of red in the semiconductor sector. And it's due to Nvidia pre-releasing bad news about revenues. They were expecting $8 billion in revenues, and they've cut that down to 6.7, so that's a massive miss on revenues. They're struggling with a lot of inventory. Remember guys, these GPUs, these graphics cards, these chips have been selling like hotcakes to cryptocurrency miners, and as the cryptocurrency market has crashed, the second-hand market, the gray market, has been flooded with second-hand graphics cards, as well as the add-in board channel has been struggling to sell their inventory. So Nvidia will struggle to clear its massive inventory buildup. It's not as bad with AMD because they command a significantly smaller market share in gaming GPUs. So even if they had over-ordered or double-ordered or whatever, they will not face nearly as much of a problem clearing their inventories. AMD is also planning to release new products, new graphics products in Q4, so that will help them accelerate the clearance of their inventories. We also have payment services, Visa, MasterCard, PayPal, really struggling. We have a bunch of healthcare stocks in the red today. Remember guys, biotech has been one of the hottest, as well as medical devices. They've been some of the hottest sectors in the past 3 to 4 weeks as the market has been rallying. Google, Facebook, entertainment, consumer cyclicals like Tesla, Amazon, Home Depot are struggling. Banks are surprisingly doing well. That's probably because they're anticipating that the CPI will be hot, and as a result, interest rates will rise. That might help banks make more profits. I disagree with this thesis, but I'll get into that later. Energy is up again, anticipating a really hot CPI figure. Utilities, real estate, and consumer defensives are in the green. This is a significant risk-off move, a defensive move. Taking a look at the different groups today, guys, energy is leading with 1.4% in the green, followed closely by utilities. Then we have real estate, financials, basic materials, and defensives, basically flat on the day. The laggards were cyclicals, technology, and communication services. The risk-on sectors, the riskier sectors that have gotten a little bit frothy over the past, let's say, 3 to 4 weeks, are now seeing significant losses. Now let's jump into the daily chart of the S&P 500. We had this beautiful rejection candle yesterday. This is a topping tail, a typical topping candle. And if you guys follow Elliott wave theory and stuff like that, and trend counts, this has actually completed a 9 count on this uptrend, and usually a 9 or a 12 count signals a reversal and an end of a trend. So the close today below the previous candle confirms that this uptrend is over, it's done. I had drawn this resistance box in my last video, expecting that there might be one last push to the upside. There might still be one last squeeze to the upside, but historically speaking, guys, in midterm years, the stock market, the S&P 500, has never, and I mean never, reached the May highs. It has never done that. Statistically, the stock market has never broken the May highs in August in midterm years. So from risk to reward, the risk is significantly skewed to the downside. I would not be buying here at all. Even if we rally, I would actually be looking to add to my short position. With that being said, guys, I have this vertical black line, and it marks the top in the housing market. In fact, let me show you that. This orange line is the housing index, and this is the SPX. The candlestick chart is the SPX, and the housing market has in fact topped on the 1st of August, while the stock market continued to move to the upside, forming divergences. This is one of many divergences, right? This is the divergence with the housing market. And on the smaller time frames, let's take a look at the 2-hour chart. There's also been this significant divergence, right? We've been making higher highs on the daily chart, right? Slamming into this resistance line as the PPO, as momentum has been dying off. Usually a triple negative divergence, like what we're seeing now, marks a top. So we have that marking a top. We have the 9 count marking a top. We have this candlestick marking a top. And then we have the divergence with the housing index marking a top. I would definitely not be a buyer at these levels. I am still holding all of my short positions. If you're interested in learning more about my positions, what I buy and what I sell and all of that, I do share every single trade of mine in the Discord group. It's $20 a month, and it's a way for you guys to support me if you want to do that and get access to a bunch of cool stuff. The link is in the description. Please check it out if you want to support me. Another way to support me, of course, is to like and comment and all of that good stuff. Thank you all. You've all been absolute legends. Now, let's jump into the housing index. This is the housing index. Again, it has stopped on the 1st of August. We've made a double top right now, and the PPO has crossed back down into bearish territory. So definitely this is marking a top, and this hasn't been just any rally. This has been a face ripping rally, an insane rally. This might end up being the bottom, guys, but that does not mean that we cannot get significant sell-offs that test the bottom or come close to the bottom. Okay, so the risk is definitely to the downside as of right now. Let's take a look at the triple Qs. The triple Qs have been going absolutely insane. The Nasdaq has been going insane. It broke out of this descending channel. We've been trading within this channel perfectly for months and months and months, going back to December of last year. We've never broken out of this channel either to the upside or to the downside until the last couple of weeks. This could prove to be a false break. It remains to be seen, but as long as we do not take out this low of June, the 270 low, this would mark the low in the Nasdaq. We also have some other indicators, including the advanced decline line, the record high index, and a bunch of other market bottom finders, signaling that this is the bottom in the Nasdaq. This might very well be the bottom in the Nasdaq. We can still get a significant drawdown into September, October, test the lows again, or come close to testing the lows again. Okay, this being the bottom does not preclude the market from selling off. My personal opinion on this is that the Nasdaq has probably bottomed, and that's due to the bottoming indicators that I've talked about, the advanced decline line as well as the record high index. I've talked about them in the last video, so please check them out. But I still do not think that we bottomed in the S&P. So we might have bottomed in the Nasdaq, not at the S&P, in my opinion. And again, similarly to the S&P 500, the Nasdaq has been putting in a divergence, right? We had a double topping divergence here with a higher low on the price action and a lower low on the momentum. This also helps us mark a top. We also had this massive rejection candle yesterday on all indices, really, the Dow, the IWM, the Russell, everything. So this is the Dow Jones. Again, we had this rejection candle. The Dow Jones is still holding up much better than the Nasdaq and the S&P, and it's due to how this index is weighted more towards value rather than growth, and value does well in market downturns. Still, on the Dow Jones, we haven't cleared the June highs. We got nowhere close to clearing the May highs. This is very typical of seasonality. In fact, let me pull up the seasonality chart to show you guys what I'm talking about. We have all midterm years in blue. We have the first term midterm years in green. My favorites out of all of these is Democratic president midterm years and second year new Democratic president are what I'm looking at, because we are in a first term Democratic president midterm year as of right now, right? So let's take a look at the red and the purple lines. we always get this rally towards the end of July into early August, right? We tend to get these. We get these in every single one of these charts. In midterm years, I was skeptical that we will get this rally because in April we did not end up getting this rally, even though in every single example here we had a rally in April. This year we had a significant sell-off in April. I was skeptical that we will get this rally because of weakening earnings. Earnings are definitely weakening and expectations are declining, but even still, we still had this rally, surprisingly. Okay. But again, even though we had this rally tends to never break the May highs, and in most cases, except for the red line, the green, the blue, and the purple, have never broken the June highs, let alone, the June highs, let alone the May highs. So far in the charts, we got really close to breaking the June highs. In fact, intraday, I think we broke those highs by maybe a couple of points. We did not close near those highs, right? This is a close. We did not get any close near to that. So far the seasonality is playing out, and again we tend to see this significant sell-off in the middle of August, towards the 3rd and 4th weeks of August into September, and then a second leg down, and then a third leg down in October. And if you notice, guys, sometimes, not always, we take out the lows of June. We do that here in the red line, the second year new Democratic president. We take out the lows of June in October. And then in the purple line, we take out the June lows in September and again in October. So it remains to be seen which one of these we will get. I am positioned for the market to come near the lows in September. I have a short position in financials on XLF, the financials S&P 500 ETF. I will be adding to that short position and jumping into a short position on the S&P 500 probably tomorrow, depending on what happens with the CPI, right? And again, I will be positioned for the market to come near the June lows. It doesn't have to break the June lows for me to make a significant profit. That's how I'm positioned. Let's go back to the Dow Jones Industrial Average. So this is the Dow Jones Industrial Average, and this is the Dow Jones Transportation Average. The Dow Transports have actually formed a higher high as compared to June, while the Dow Jones Industrial Average has not. So this has created a divergence, and according to Dow Theory, when you get a divergence between the Dow Jones Industrial Average and the Dow Jones Transportation Index, we tend to see a reversal of the trend, and the trend has been to the upside the last several weeks, and that indicates that the trend will now reverse to the downside. Again, another point to look at that suggests that the market has topped, or at least the short-term rally that we've seen, the bear market rally, has probably topped or has come close to a top. Again, let's take a look at the Russell 2000, the IWM. We had this massive rejection candle. The IWM has been significantly frothier than the rest of the indices, primarily driven by small cap meme stocks and highly shorted stocks. We've had a massive short squeeze in the market, so the Russell was outperforming the rest of the indices, and we did in fact break above the May highs, but we did not get a close above the May highs, right? We tested intraday, and then we rejected and moved down, again suggesting a top. Let's take a look at the high yield bonds. These are also called the junk bonds. In a previous video, in several previous videos, I talked about a interesting 5-phase move in the high yield bonds that were suggesting that the market is probably going to turn around. I did not touch this chart at all since I took my vacation. So I've not touched it at all. It's been the same. I did keep this gap, and I did talk about this gap because I expected possibly some more frothiness to come into the market. It has played out almost exactly as I expected it would, right? We had this frothiness. Now we are seeing significant slowing in the momentum, right? If we take a look at the 2-hour chart, we will see a very clear negative divergence, right? We had a high, another high, and then a third high, and it's been diverging, right? We've been putting in highs and we've been putting in lower highs here, so a very clear divergence suggesting a top in the high yield bonds. And so what happens next? The last phase in this 5-phase period is a declining phase. This declining phase will signal a sell-off. In fact, we have probably already started the sell-off yesterday. We're getting really close to a bearish crossover on the PPO. Where this sell-off takes us, it's really difficult to say. We might test the lows, and alternatively, we might actually form a reverse head and shoulders, excuse me, an inverse head and shoulders pattern, and that is a bottoming pattern. So we might see something like that. So I will be looking at the 76 level on the high yield bonds. I do expect the S&P 500 to do something similar to this, maybe show some declines as the CPI comes out, right? These middle of August declines that we usually see, then possibly one last push to the upside, and then the massive sell-off coming in towards the end of August. Now let's take a look at the 10-year yield. The yields have actually been forming a bottom. Here we have a bullish crossover on the momentum, and it looks to me like the 10-year yield wants to push up. My target is around 3.2 to around 3.1, so somewhere around here, to form a head and shoulders topping formation. That's what I'm looking at. I do expect to see a pop in the 10-year yield. If the CPI comes in really hot, we will see yields move up, and we will see the dollar index move up, and those will put a lot of pressure on the stock market, specifically the Nasdaq, right? The dollar index has been trading perfectly within this bullish uptrend within this channel. We have respected this channel. We have not broken outside of the channel so far. If the CPI comes in hot tomorrow, significantly hotter than expected, we will see the dollar index shoot up. If we see signs that actually inflation is probably topping and rolling over, we will see a breakdown in the dollar index and a breakdown in yields, and that will be very positive for the market. It remains to be seen. It's a binary event, okay? So I'm actually not positioned to play the CPI tomorrow because it's a binary event and there's a lot of volatility baked in. In fact, the average expected move for tomorrow on the S&P 500 is $5, and for the Nasdaq it's $9. So that's kind of insane, right? $9 would take us from 317 to 306. That would take us all the way down to this level here, and actually makes sense, right? So this was resistance, and it will act as support if we pull back. So I do expect the market to hit this level again, and it's actually sitting at the upper edge of this descending channel, so it makes a lot of sense in many ways. And the options market is very efficient, and it's pricing in a $9 move in the triple Qs. Now let's take a look at oil. Oil has probably formed a major top right here. We talked a lot about this. This is a perfect distribution pattern, a topping formation, right, where we get this blow off top, a second test, a soft test with a rollover. We did get that, so this is probably the top in oil for now, okay, for this cycle. And we've broken this critical support level at $100. We are now back testing that level again in preparation probably for a move to the downside. Remember guys, if CPI comes in hot and the dollar moves up, oil might actually still come down, because if the dollar moves up, that means commodities can go down, right? Strengthen the dollar would bring prices down in commodities, including oil. But if the CPI is significantly higher than like so much higher than expected, we might see oil shoot back up. It's going to be really interesting to watch. I am watching a test of this previous high here at $85 to $86. That makes sense to me to see oil test this level before trying to move back up. So that's what I will be watching. I'm not positioned either way. Let's take a look at this ratio chart. This is the XLY, consumer discretionary, divided by XLP, consumer staples. This chart is one of the best charts to look at if you're trying to gauge if the market is risk on, i.e. moving up, or risk off, i.e. moving down. And we had a rejection here, a double top formation, right? And we are decisively moving down now, and this signals a risk off move. absolutely typical of what you would expect running into the CPI print tomorrow. Another ratio chart here, the triple Qs divided by the S&P 500, Nasdaq divided by the S&P 500. We had a blow off top right here. We are seeing a sell-off right now. Again, I do expect a touch of this upper edge of the descending channel. This blue line, guys, is the 200-week moving average, not the 200-day, the 200-week moving average, right? If I took a look at the weekly chart, I did draw this line to see where the 200-week moving average is, and a significant sell-off in the stock market would probably mean that the triple Qs might touch the 200-week moving average again, or the ratio, okay, the ratio of the triple Qs by the S&P 500. Again, if CPI comes in hot, stocks that will get hit the most are the Nasdaq stocks, the growth stocks, tech sector, and so on. Now let's take a look at the Semiconductor Index. The Semiconductor Index has broken out of this resistance channel that I've drawn up, and it's been working perfectly for us going all the way back to December, right? So this has been a really nice channel for us. We did form a inverse head and shoulders bottom right here, and I did call the bottom here. I did in fact buy semiconductor shares, specifically AMD shares, a lot near the bottom. I got really lucky in catching the bottom, and now we've broken outside of this resistance channel. This red line, guys, signifies bullishness above this line and bearishness below. So if this is the bottom, and I do suspect that it is probably the bottom in semiconductors, we will see something like this, a retest of this red line that takes us really close, right? Really close to the lows. And this might be the perfect time to load up on more shares, more leap options, things like that. This is the semiconductors divided by the triple Qs, okay? I am still waiting for a touch of this 200 weekly moving average. This will probably signal a final trend reversal for semiconductors, where semiconductors can start moving back up. We might have bottomed here, but we're still in a range, and I do not expect any significant breakouts, any significant changes in the trend until we touch this 200 weekly moving average. Look at this, guys. We've systematically touched this 200 weekly moving average and moved up, touched, moved up, touched, and moved up. So I do expect a touch of this 200 weekly moving average right around when we see a touch of this a red line. That would be a really nice technical signals if we see a bounce off this line, and then we see a bounce off this 200 weekly moving average. That would, in my opinion, make a really nice opportunity to go long on semiconductors. Let's take a look at Nvidia. Nvidia pooped its pants, right? Yesterday, they pre-announced. They're supposed to announce earnings not next week, the week after, I believe. But they pre-announced because their revenues missed massively. They were supposed to report $8 billion in revenues. This quarter, they actually reported that they will miss that. They will only rake in 6.7. That's a massive miss for Nvidia, and this will probably lead to a capitulatory bottom in Nvidia, right, where we see a touch of this ascending channel, this lower border of this long-term ascending channel. This channel goes back to 2016. We've never traded outside of this channel for over 6 years now. So this channel has been working really nicely for me. I was also tracking this descending wedge, right? And as soon as we broke out of this descending wedge, we had this massive rally in Nvidia. So this was a nice trade as well. But I am more interested in loading up on leap options in Nvidia. Less so shares. I like AMD shares more, but leap options on Nvidia if we see a touch of this lower border of the ascending channel. Let's take a look at Tesla. Tesla has actually formed this massive bear flag, right? This massive bear flag. We consolidated, we formed this bearish pennant, and then we broke outside of this bear pennant. But if you notice, guys, we have a reversal here. We have a bearish crossover on the PPO, and we actually formed a lower high on the momentum. We have consistently formed lower highs, right? And every single time this happened, we had a major top in Tesla. So this probably is a major top in Tesla, and it reversed right around the 200 daily moving average. Again, a perfect reversal. Where will it go next? Well, I do expect Tesla to give up all of these gains and then some. A full measured move on this bear flag would actually take us down to around 500 bucks. And possibly even more than that, right? 500 bucks is the upper edge of this consolidation zone here. We might see Tesla trade in the middle of this consolidation zone. So 500 to 400 bucks is my bet on Tesla. I do not have a position in Tesla as of now, but I might actually open a short position really soon. Let's take a look at GameStop. Again, a massive rejection candle right here. We did not manage to break above this high, so we remain in a long-term bearish context on GameStop. So I do expect GameStop, the insanity, the rally in GameStop to probably take a breather, possibly end here. It makes sense, right? We did not manage to break the highs of the previous pop to the upside. So I'm not in GameStop. I do not trade the stock. The options are too expensive for my liking. But this is just what I think is probably the top for now. Let's take a look at AMC. We've been waiting for this break above the 200 daily moving average on AMC. Not only did we break above, we actually closed above for the first time in a long time. But unfortunately, we had this massive topping tail rejection candle, and look at that, guys. Just look at how similar this look is. Rejection candle, sell off, rejection candle, sell off. So this is probably the top, and look at that again. We did not manage to clear the highs of April, so we still remain in a bearish context despite everything that you've been hearing. Even if the market has bottomed, which I doubt on the S&P 500 specifically, we are still in a bear market. And this confirms it, right? We did not manage to break the previous highs. In a real true bull market, we would make higher highs, not lower highs. If you are in this trade, and again, this is not financial advice, but if I was in this trade, I would probably have gotten out right here. But if you actually held on, this is still a nice opportunity to take your profits and run. Let's take a look at BBBY, Bath Beyond. I actually like this stock. Okay, this might surprise you, but I actually like this stock on fundamentals. Unlike GameStop and AMC, I actually like Bath Beyond on fundamentals. We had this beautiful double bottom formation with a higher low on the momentum, right? Momentum was turning up as the price action was slowing down. This was a perfect bottom if you managed to catch it. I wasn't actually following the Bath & Beyond that early, unfortunately, so I did not catch this move to the upside. But I like this stock. I really do like it. I still think it has a lot of room to run. Remember, guys, this is a company that brings in $7 billion of revenues every year, and the stock or the company is valued at $900 million. So there's still a lot of room to run fundamentally. Again, fundamentally, the company is actually making losses. It is losing money, but usually that's the best time to get into a stock is when the company is actually losing money and is beginning to turn around and possibly make a profit. That is the perfect time. That's when you get deep value investments. And that's in fact when I got into AMD. In fact, let me pull up this chart for you guys. I actually got into AMD, believe it or not, I got into AMD here at $1.8. When everybody was saying that AMD is going bankrupt, this company is done, Intel destroyed this company, AMD has no chance. I knew for a fact that AMD was not going to go bankrupt. I knew that they had a super weapon coming in the pipeline in the form of the Zen architecture. And eventually the Zen architecture ended up really beating Intel's head in. The Zen CPU architecture is superior to Intel's architecture in every single way. And performance per watt, and the size of the chips are smaller, so they're cheaper to make. It's a superior product in every single imaginable way, and it's also cheaper to buy. So I knew all of that was going to happen when they announced that Jim Keller was going to come on AMD. I'm going on a tangent, but I'm just trying to explain why it is the perfect time to get into a stock when everybody's saying that this company is going bankrupt, they have no chance. Back here, guys, AMD was making $4 billion in revenue. Bed Bath & Beyond is making 7. Obviously, it's not the same growth trajectory and all of that, but still, this is such a cheap company, and I do not expect at all that Bed Bath & Beyond will go bankrupt at all. So I do like the stock on fundamentals. And I am still looking for an entry. I'm still looking for something like this, so for some consolidation and then a break above this channel for a continuation to the upside. I do not think that this rally is done. In fact, I think this is in the early innings of a massive move to the upside, similar to what we've seen with GameStop in the early days. But again, I'm not in the stock. I do not recommend that anybody buy the stock based on what I'm saying. Please dig into it yourself and make your own decision. Now let's jump into the beat rate on earnings. The beat rate is at 64%. This is actually terrible. 64% is actually atrocious. Usually we would like to see 75 plus. So even though earnings expectations have been coming down, companies are still missing earnings. This beat rate is absolutely miserable, and these earnings do not support the rally that we've seen in the market. That's another reason why I do not believe that the S&P 500 has actually made a bottom. I think we still go lower than 360 bucks. Probably to 350 to touch the 200 weekly moving average, right around 350 sometime in September or in October. Let's take a look at the fear and greed index. We're sitting at neutral, 49. Yesterday we were sitting at 50, so we are slowly moving down. Let's take a look at the timeline. Look at this, guys. Fear and greed. We had this insane greed reading, extreme greed on November 9th. That marked the top in the Nasdaq. Another one, greed 66, January 3rd. That marked the top in the S&P 500. Boom. Greed 62, 4th of April. That marked the bear market rally that we had late March. And boom, 50. So we're making lower highs. We're still in a bear market despite everything you've been hearing. We are absolutely still in a bear market. And this is one other indicator that suggests that we're still going to move down. So we're turning around from 50. We could still see something like this, guys, a final push to the upside. But as long as we never touch 62, if we let's say hit 59, 60 in a final push to the upside, that would still mean that we're in a bear market. Again, market momentum, we are turning back down before even hitting the 125-day moving average. We got really close. Again, we might see one final push. We break through that, and then we get a rejection similar to what we've seen in February, similar to what we've seen in late March. Stock price strength, extreme greed. We're sitting at extreme greed readings. Stock price breadth. This is the breadth indicator, and this is a hallmark of bear markets, when you see a massive move to the upside and then the breadth is actually declining, meaning the stock market is moving up, but most stocks in the stock market are moving down. How does that happen? It happens because the big cap companies are moving up and they're pushing up the indices, while the smaller cap, the everyday companies are actually moving down. This is very typical of bear markets. Again, guys, breadth is declining as the market is rallying. Put to call options, we are sitting at really low readings here, guys. Again, signaling complacency. Even though we have the CPI coming in tomorrow, we're not seeing a jump in the put to call ratio. This is a contrarian indicator. When you see people buying more calls versus puts, it means that the market is probably going to go down, right? And when most people are piled into one side of the trade, being bullish in this case, when most people are bullish, that's when the market tends to move down. I do expect to see a spike in the put to call options and a spike in the VIX. In fact, let's take a look at the daily chart of the VIX. These are all the major sell-off signals that we've had so far to date. We are getting really close to signaling another major sell-off signal. What I'm waiting for is a crossover of the PPO, right? I'm waiting for a bullish crossover because every single time we had a double bottom formation with a bullish crossover, we had a significant sell-off, a massive crash. Again, it happened here. We made a double bottom, bullish crossover, massive sell-off. So this is a spike in volatility. It means a massive sell-off. Again, spike in volatility, massive sell-off, spike, massive sell-off, spike, massive sell-off. We did form a double bottom here. I'm still waiting for a bullish crossover for a massive sell-off. And to show you how well this has predicted sell-offs, I will in fact add the S&P 500 to this chart. And there you go. Look at that. It marked the top. It marked the top. It marked the top. And right here, it marked the top. Right here, it marked the top. So I'm still waiting for that bullish crossover. As soon as we see that bullish crossover, again, that would be another signal that a precipitous sell-off is coming in, guys. So be very, very careful. Safe haven demand. This is the difference in 20-day stock and bond returns. People are dumping stocks and they're buying bonds. This is a sell signal, another sell signal, a bearish signal. Junk bond demand. Junk bonds are selling off again. We've actually formed this beautiful bull flag in junk bond demand and yield spreads between junk bonds and investment grade. So again, another sell signal. So what do we have tomorrow? Tomorrow we have the core CPI, the CPI, and we also have on Thursday the jobless claims and the PPI. In my opinion, the PPI is significantly more important than the CPI because it's a leading indicator. If for example, the CPI comes in below expectations, so if we get a reading below 8.7, and then on Thursday we get a PPI reading that's higher than expectations, this would probably make the worst bull trap that we've seen for a while, because again, PPI is a leading indicator of CPI. As long as the producer price index is rising, the CPI will rise with it. And on Friday, we have the 5-year inflation expectations. So a bunch of economic drops coming in the next 3 trading sessions. Tomorrow will be all about CPI. It's coming in at 8:30 a.m. So so just before the market opens. So the way I would look at this, guys, is I would not be trying to predict what the market is going to do. Even if we see, for example, a sharp sell-off or a sharp rally pre-market, I would absolutely be very skeptical of that. I would wait to see what the market does. In fact, I would probably wait for the PPI on Thursday for making a decision. But every single indicator is suggesting that the market has topped, this rally has topped, and we're starting to see a reversal to the downside. That's all I have for you today, guys. Thank you so much for watching. Please check out the Discord group if you're interested in supporting me. I love you all, and I'll catch you in the next one. Bye-bye. Oh, wow!